Thank you, Janak, for the kind introduction. Good evening, everyone. Let me go to my first question. Looking back over the past 10 years, what would you highlight as the biggest structural change in Sri Lanka's life insurance industry, and how has that reshaped the way industry operates today? So, Mr. Iftikhar,
I'll, I thought that was going to do that. Just to- so, right. So I think the life insurance industry is a very interesting subject. I think we are all here to kind of tell you the long-term prospects. It is not a speculative business. It's a long-term business, as the word implies. Actually, the IRCSL, they don't call life insurance companies as life insurance companies. They actually title them long-term business and general insurance business. So I think from that itself, you get the idea that it's a long-term business. The average contract that we write is about 15 years, right? So it means that you have to be around for 15 years. And that means also that what you're doing is you're selling a promise to someone that you will be around for that long. And not only that, that during that lifetime, that you will fulfill and provide all those promises and benefits that you said you would. Now, the good thing about the industry is that growth has picked up substantially. We are growing at about 20% now, I think, over the last couple of years. And if you look at even the first quarter of 2026, I think the industry grew at about 25%. So uh, that's quite a substantial jump and a substantial move from what it used to be maybe about 5 or 7 years ago. So in that sense, there's been a structural shift. I think the competitive nature of the market has basically tailored that. And if I were to talk or mention a little bit about SoftLogic Life, I think the incidents that happened in the country over the last maybe 5 or 6 years, including COVID, right? Where people then realized, okay, if I fall sick and if things are uncertain, then I need to be sure that there is some kind of reassurance for me and my family. So events like that have also shaped how life insurance has evolved. From a life sector perspective, life insurance companies can do both life and health. So from that perspective, uh, things have moved very positively. And I think from where we see today, and especially we look to the future, there is a whole big uh, protection gap because people are getting older. People are not from a national standpoint. We don't have enough protection in terms of savings and money for retirement. So, given those items, I think the future for life insurance also is very steady and very optimistic.
Thank you. Thank you. So, Mr. Lester, why don't you okay.
I think I did that actually. If we take last 10 years, I think sorry. So, yeah, I think added to what you have said that yes, if we look back 10 years, the segregation actually really help us to restructure the industry because then from 2015 onwards, most of the big players they segregate life and general insurance business except few, and US Sri Lanka Equitas, a company they did it I think in 2024, but as companies they did way before. I think that really helped us to focus on one business line, especially since we are talking about life insurance here today. Yes, all the life insurance, specific life insurance companies started focusing on life business, long-term business. So as a result, as Itika said, we really grew as an industry. All we have recorded since then at double-digit market growth, and last 2 years, 20%, and this year, of course, already 25% growth as an industry. So especially the during difficult times, East attack to COVID, to the recession and the trial, we have gone through as a nation a lot of crisis, and still we are growing well above the regional average and always double-digit growth. So that segregation really helped us to actually restructure the industry. And so I think that's the main point I would say. Yeah.
Thank you. So, last wish is your
So just to add on to what was already discussed, I see there are few structural changes that happened over the last 10 years. And firstly is obviously there was a proliferation of the type of products that are bought and consumed in the market. The traditional, protection products, uh, which were seen 10, 15 years ago, has now evolved into a much larger, broader landscape. The onslaught of digital capability, the awareness on health, critical illness has really seen the industry being very innovative in what we say. Uh, Health insurance took a rapid uh, path of growth over the last 10 years, where we saw many of the players really focusing on this sphere and growing their business on that platform. We saw many of the industry players moving also into the universal life platform, which gives a more transparent return to the customer compared to the traditional forms of business. So there was a expansion in the types of products that are bought and consumed in the industry. Secondly, there was also the massive structural changes in how we distribute products to customers. So the traditional agent-based model evolved into bank assurance. It evolved into our group businesses started to really expand over the last 15 years. Uh, Digital platforms were leveraged not to a great scale, but to some extent to start distributing products. So there was a also structural evolution of how we distribute. So not just a product, how we distribute products, and in combination, as what was discussed already, this continuous growth momentum has really positioned life insurance as a material industry in the ecosystem. So today, if you look at the total life insurance funds in combination, accounts to almost ₹1 trillion. Just to put it into context, it's almost one-fifth the size of the EPF fund. So this gives the industry, it's a testament to how far the industry has come over the last 15 years, and really the potential it has to grow the future.
Thank you. So my next question also will be to you. So this is despite the double-digit growth and developments, Sri Lankan life insurance industry penetration remains relatively low compared to the regional peers. So my question is, why do you think life insurance penetration in Sri Lanka remain relatively low compared to its regional peers? And what could be the practical steps that can industry take to reduce the gap?
So I would, in my view, think the root cause of this low penetration is the lack of awareness. If you look at Sri Lanka's financial literacy rates are below 60%. It's in the big 50s. And we've seen globally, with financial literacy rates improving, you had life insurance penetrations going up. So Sri Lanka's overall lack of awareness of the need to insure yourself, awareness of the proposition life insurance plays in your financial journey, or the positioning of life insurance in a household's overall financial security is not known by the masses. And that is a big part of why penetration is low. Secondly, I also feel that a key a pivotal factor to grow penetration is for the masses to adopt life insurance. Now, for the masses to adopt life insurance, in addition to awareness, you also need to make life insurance less complicated, simpler to purchase and consume, and also affordable to. For whatever reasons over the last 5 to 10 years, this country has gone through various economic, cyclical movements, right? With that, obviously, household savings rate affordabilities have taken a hit. With that, as an industry, we've seen that affordability in the mass segment is also restricting the ability for life insurance to penetrate to at least the rates of one that we see in India. In Sri Lanka, it's about 0.8%, 0.9%, when India is close to 3%. So that these two are somewhat of primary factors I feel that life insurance is still heavily underpenetrated in this country, which also gives the a view of what's the true potential of this industry, or what the true potential of the industry in the future. In terms of what the industry is doing, I think Lasida would be the right person to talk to as the ISL president. However, the industry is also looking at a 7-pillar roadmap. And whatever we do to drive penetration, we'll have to revolve around product innovation, make products relevant, affordable, accessible to customers, distribution innovation to ensure that we are able to distribute products across a multiple or a broad customer segment and enable customers to buy and experience life insurance in the most convenient manner. And these sort of aspects will help drive penetration in the long run. But also a key factor to drive penetration is how the state also incentivize or encourage individuals to purchase and experience life insurance. A few years ago we had this, allowable there. You could deduct your life insurance expense up to a particular value of your when computing your income taxes. And these sort of incentivizations help people look at life insurance in a positive light and also help drive awareness. Today, if you look at Sri Lanka government expenditure, almost $1 trillion is spent on public health care and pensions. This is a large cohort of this could be absorbed by the life insurance industry if you really start encouraging individuals, the mass population, to enter into the life insurance sphere. So these are some of the initiatives that are already in conceptualization stage, but also be discussed in broader forums to drive penetration.
Thank you, Mr. Stinan. So over to you, Lester.
I think adding to what Senath said, apart from the lack of awareness, the disposable income factor is the other key contributor, because our per capita income now I think it is touching around $5,000, but still it's not enough. People if you talk about the mass, they have a lot of other commitments than paying for a life insurance premium. So, but that is one thing. Of course, if we can enhance the financial literacy, of course, that we can address that to a certain extent. On top of that, our per capita income will increase in this country, and so there are a lot of researchers being done. One said that it goes beyond 6,000 per USD. There's a tendency of doubling the size of it. The industry, there were so many researchers we have seen in the Asian markets. We hope if it goes beyond 6,000 USD or above, and definitely there's a potential of doubling or tripling the size of the penetration. But having said that, having 0.6% from life itself is not sufficient at all if you talk about the contribution to the GDP. But headcount basis, of course, we have touched good 30-40% of the population. Some of the other based on various product types, micro product, group products, everything together. Compared to the region, I think only Pakistan, maybe Bangladesh, maybe Nepal, they are behind us. But the rest of the players are well above. India 3 times, 3% mean is a huge jump compared to our 0.6. Even Indonesia, with such a massive illiterate population, they are having 1.5% penetration. So what we are trying to do, if we continue to go as it is with an average of 20%, of course, slowly we can improve, but that's not the case. How to double or triple the size of this industry? That's what we are now discussing at our level, CEO's level, and also with the regulator. Now they are really pushing us, and we are together with the regulator, then the Insurance Association and the Brokers Association. We put up a roadmap. You must have seen there is this initiative what I'm talking about, because already telecast in various media channels. What we are trying to do, we put up a very specific roadmap. It's 7 pillars to double the market size by 2030. That's the first milestone, and then triple the market size by 2035. Very specific roadmap.
That's the promise. Together as with all the stakeholders, and we are very positive about that. All the CEOs are really supporting, and all the CEOs are mentoring all those pillars. They have 29 CEOs in industry, 40 from 15 from general insurance, along with all our technical people, marketing people, regulator, and there are representatives from finance ministry as well. So it's a combined journey, and we need government support big time. We need incentives, tax incentives, and to change certain regulations and understand how other countries achieve penetration. So we have to learn from those territories. I think we are on the right track. We believe we'll be able to achieve all those milestones. The first one to achieve double the market share, or rather double the industry size, and then triple it by 2035. So I'm 100% positive we can achieve that. And if we can achieve that, and we can take a high lot of burden from the government also in terms of health insurance, retirement insurance, and all other things, I think that's the way to go. When you look at other countries, insurance companies are basically running the show. I think they are the sector was taking a certain burden of the government, and it's end of the day what you're doing the social sex. So we believe we can do it together as an industry. I'm very positive about that.
Thank you, Respect. This was very insightful. And lastly,
Yeah. So I think at a slightly different perspective on this whole thing. So just we talk about awareness. If you put on your TV, right, and if you see what comes on, I think you find insurance advertisements coming fairly strongly from the insurance sector. So, and if you look at it on your mobile phone, Sri Lanka has 100% mobile penetration. You're proud to see something about insurance, right? So I think technology and media has enabled us to tell someone that there is something called insurance, and if you want to get it, you can get it. There are a couple of issues, right? The issues continue to be that unless insurance is mandatory, like for example, insuring your car, right? You tend to think, I can spend my money on something else, right? And this is something that we always say. We believe, or when an individual looks at it, he believes there was something bad is not going to happen to him or her, right? It's going to happen to the next guy. So I'm going to be okay. So therefore, I don't need insurance. So typically, then what life insurance companies do is we incentivize people to actually go and convince you that you need insurance, right? So that's one aspect of it. The other aspect of this is something called inflation, right? So Sri Lanka, unfortunately, in terms of its economy, has experienced a significant inflation. If you take last 10 years, I think average is 10%. So if you had a return of 8%, right, and that's, I think, typical insurance return, you already didn't make any gain out of that whole investment. So I think, at the end of the day, there are fundamental issues in terms of the economy. And the other one I also is disposable income, right? If people don't have the money, they obviously can't, the insurance is the last thing that they worry about. And I think whilst you have different blocks of society, if you look at particularly the bottom of the pyramid, and even some sectors of the informal economy, those are the ones that are actually exposed in a big way. And the challenge continues to be how to get those segments covered. So I think that the guys who are at the top, who are at the middle, and who are working for corporates, etc., there's cows. But I think those blocks are significant blocks that are out there, and that contributes in a significant, in a substantial way to under-penetration.
thank God. We got mixed perspectives for this question. So, what's the real problem we see is by 2040, one-fourth of our population is above 60 years. So, how should insurers be evolving their product mix today to meet the future demand for retirement income and long-term health and care solutions. So,
No, absolutely. So I think there was an OECD event in Colombo about maybe 2 or 3 weeks ago, or maybe a month ago, and that focused primarily in terms of the protection gap, right? So the bad news is that we are getting older before we have become rich, right? We don't have money to get old. Before we can make our money and before we can be stable in this situation, we have got older. We are getting into an old people's economy. I think, and one of other panels, there was this interesting examples that was brought up. It's a bit far-fetched, but I think it conveys the point. So nowadays, these days, you tend to, in the morning when you're on your way to work, you go and drop your kids at school, right? And then you go to work. In time to come, right, it's this whole progression, and it's going there. There is no doubt about that, because we can't change that in a hurry, right? If the aging goes at this process, you probably will be dropping your parents or your grandparents to a old elderly care place and picking them up in the evening, because there won't be anyone at home to look after them, right? So this situation can very well reverse and have a substantial impact on society. So the aging thing is happening, right? The issue is that there are two things that need to be provided. There has to be healthcare, and there has to be money, right? Basically, for you to live the rest of your life. Now, in both these areas, I think both have from a state level, from a government perspective, as well as from a insurance industry perspective, we need to work together, and I think that's why this whole roadmap and plan, I think, will hopefully address this, because there is that gap in terms of, okay, you're getting old, you're more likely to fall sick, right, when you're older. So then, how are you going to manage that expense? Number one. Number two, right? In terms of the funds to the money for you to live the rest of your life, where is that going to come from, right? Because there is only a very limited number of people who have pensions. I mentioned previously also the inflation issue, right? That is also taking value away. But in terms of the market, the insurance market, there are hardly any, what we call decumulation products, right? We have all accumulation products where we accumulate, and we pay a lump sum, right? We hardly have it the other way in terms of like annuity, where you get for the rest of your life, right, a certain amount of money that is paid to you. So I think that is where we need to focus on, right, in terms of addressing, especially this 1 in 4 and this aging situation. And hopefully we will do that, because these are substantial problems that are coming up for society. And I think we need to quickly, urgently address this, because there is no reversing this trend. It's on the way. It's going to happen. And the only thing that we can do is start addressing it as soon as we can and get as ready as we can for this situation.
thank you for your views. Over to you.
Yeah, adding to that, actually, yes, we have seen that risk. Of course, living long, of course, die. I mean, die early and living long, both are fundamental risks, but we are taking as an industry. Now, if we talk about living long challenge, yes, pension products is one of the solutions. So most of the companies are they're having many, such retirement plans, and also this annuity concept. It's not that common in this market, our market. Kind of a new proposition, but I have seen few companies, they have started building annuity policies, including my company, because they have seen that risk. Why not you put a lump sum and get it in installment basis by with the mix of non-insurance cover, well, there are various type of annuities. Some of them, will give a coverage till you're dead. So there are products, and we are now pivoting all those products in the industry, and of course we have to come up with such products into the future. Otherwise, we will get out on the competition. So as a company, we realize, and as an industry, we realize the need of having energy solutions. On the other hand, health, typical health products, cease at age. It's very difficult to price, because especially in our market, unless you write it to net, where insurance companies will never help you to insure beyond an age. So definitely, then it's a huge risk, is because we don't have data. When we try our best to negotiate it, top end reinsurers, especially the long-term care product, which is a world famous long-term care product concept. Why we can't bring it to this market? Still, we don't have. The only barrier is that we don't have data. Our health system getting data is a miracle. I mean, because there's no central database. So hospital wise, still most of them are not in on system. So therefore, we have huge challenge. Recently, as an industry, we met with the health minister, the equity minister, and the secretary. We asked them this ICD coding development and all other things, when they are going to do those things. Otherwise, we can't digitalize this industry, and we can't do innovations. But I don't think it'll happen in the near future. Even minister said so hard, because we have data here and there. So creating all this, connected is a big challenge government is facing. If we did have anything, then it would have been easier than, connecting the existing systems into a one. That's the challenge this current government is also facing, and that's also the case throughout. So if we have data, then we can price, those risks can offer innovative solutions with the support of reinsurance. Otherwise, companies, they had to do experiments, and it may go badly wrong. So there are examples in other markets. So therefore, we are a little bit reluctant to take such risk without knowing the risk that we are going to take. But of course, way forward is, yes, we must have products to insure the nation. Otherwise, there'll be huge problem going forward. We have seen that risk, and like Japan, the classic example. I think we are going to follow that road very soon, and we are trying our best to gather data and be ready with products to insure old age people.
Thank you, guys. So, final over to you.
So the answer to your question as to how insurance companies are reacting to this phenomena or this change of dynamic. See, if you look at product innovation over the last 10 to 15 years, most of the life insurance product innovation or evolution in this country was centered around health and protection, not necessarily on the retirement proposition. Now, if you look at the standard retirement product, and this is, there can be exception to the norm, but the norm is you have a 30-year policy, you have a premium waiver the letter of a debt, that you have the possibility of a lump sum. That fundamental structure hasn't changed over time. However, the demography has changed. The demand and needs of the customer has changed. Now, for us to be able to offer a solution that is relevant to the evolving customer base, consumer, requires us to also evolve our retirement proposition. Now, people enter the workforce at the age of 80. It's not the mid-20s or early 20s. They work out till 60, no longer. But they're living longer. So you work for 42, 45 years, then, and I don't mean this any negative way, but you live long. You live up to 85, 90 years old. So your retirement age is almost 60% of your work. So within that working life, you need to fend a retirement proposition that can take care of your needs, your evolving needs, not just your basic needs, because you're used to a particular lifestyle. So it needs to be able to take care of your evolving needs for another 25 years. And some of the developments that we are looking at, and not just unique to one company, but the rest of industries, how do we make products more relevant? How do we make sure we go beyond the standard 25, 30-year policy? How do we offer 40, 45-year policies? How do we make sure that we also build the ability for the product to evolve with the customer? Because at the age of 80, when you enter, your ability to afford a premium evolves over time. And so does your financial need for protection at the time. So your product needs to evolve with you. Your product also cannot be a single dimension. It cannot be just retirement, because as I growing older, as I retire, my need for health, my need for long-term care, they will also evolve and expand. So your product needs to be comprehensive, composite, and it needs to align and evolve with your lifestyle. So that type of dynamic product innovation is required. That is happening. Secondly, now as a life insurance company, for us to be able to offer a proposition for someone who is 18 years old that will last until the age of 90, we need to be able to also make investments, long-term investments that can generate sufficient returns to make this proposition attractive. Of today, 60% of the life insurance industry proceeds are invested in fixed income. And fixed income, we're looking at 8 to 10-year horizons. How are we going to offer a proposition that extends for 45, 50 years or even beyond with this limited scope? So there has to be instruments, yes, fixed income instruments that extend beyond 10 years, 15, 20, 30 year. It's not to be solid instruments, it can be corporate instruments, but also we need to expand the admissible asset base that insurance companies can invest in to enable the growth of funds, to make it material enough to be relevant in your retirement, but also to enable the product to evolve as that when you evolve in your own career and affordability. So for the simple answer to your question, product innovation in the retirement space need to happen fast.
Thank you, Zainab. This was very insightful. So when we talk about products, there are saving-oriented products that are becoming popular within the industry, because when the salespeople comes with the type called tax-free. So in terms of over the past decade, how has the balance between the saving-oriented products and payer protection covers changed in your portfolios, and what mix do you expect in the medium term?
So we call it protected savings, because obviously every savings product has a protection incorporated into it. As I said, traditional insurance policies always had a savings component, but the customers' demand for savings products have evolved, and based on our own experience, we've seen that customers now want to have visibility and transparency of what you're offering. If you are telling me that you will grow my fund, I need to have control and visibility as to how you are growing my fund. And that is where we saw over the last 8 to 9 years, a lot of companies moving into the universal life platform. There it's a type of product where you share the investment return. So the customers can easily compare the return given by an insurance company with either market rates or a alternate instrument. So that sort of visibility and transparency is something that has attracted customers. At least we've seen that over the last 7 to 8 years. And that is a space that we will have to evolve, because customers will also no longer be happy with 1 or 2% more than a risk premium. If I'm investing in insurance, I may not necessarily have the same liquidity I had investing in a savings or a fixed deposit. Now for that, your premium you pay me as an insurance company should be much greater than what a bank or the risk-free rate. Now that requires insurance companies also start innovating and expanding in how they create value. Right, so that is where I come back to asset classes, expansion in asset classes, options available for insurance companies, admissibility of assets to encourage insurance companies to invest in much longer term assets beyond the traditional asset classes. All of these will help evolve this, because whether we like it or not, customers will take on, because customers will and is becoming more financially literate thanks to technology and democratization of knowledge. Customers are being more financially literate. So We need to play catch up. We need to evolve our protect the savings proposition. In addition, as I mentioned in previously, for example, today, customers we have a massive public healthcare system, but customers are still willing to spend money, even borrow money, uh, uh, and go and had access to. I don't take that because that's a basic need to have access to quality healthcare is a basic need. So that healthcare product will evolve. Irrespective of the public healthcare system or access to public healthcare, customers will demand for private healthcare. And insurance will be the only sustainable way of gaining that access. Because household savings rates in Sri Lanka are not large enough for you to be able to absorb any health shock. And the only way you can absorb health shock and be able to afford private healthcare is via insurance. So this space will evolve and needs to evolve to ensure that we are able to attract and service customers the way they expect the service. Secondly, if you look at non-communicable disease are the fastest or the largest cause of mortality in this country, right? And critical illness covers, protection covers need to also evolve, and customers need to be educated of the options that they have, and will want to have access to broader protection covers than what they do right now. So as I mentioned at the start, rapid and continuous product innovation with the changing consumer dynamics and demands is pivotal for this industry.
Beautiful.
Thank you, Sainat.
Yeah. Yes, actually, the mix is basically based on the return strategy. Some companies are, focusing protection more than investment. It's always depends on your internal strategy. But having said that, there's a tendency in Sri Lankan mindset is always, they expect something in return. What I have paid, what I'm getting. So they compare insurance with a bank account. I mean, you can't come there because there's a component your pay goes to your protection fund. You won't get it back unless you claim. So people should understand, why they are putting money in insurance. You get, of course, a maturity if it is a universal or a product like participating product with bonus. You will get some sizable maturity value, but you can't ever compare your investment amount to total premium versus your return, because then you are not getting the insurance concept right, because we have to have a risk premium, otherwise insurance companies also will not survive. So sometime back we have learned our lesson as industry with unit link products. I think 15-20 years ago, a couple of companies came up with unit link, and we sold a lot of unit link as an industry, but it failed miserably because our market, our customers, they don't have a discipline of waiting and see a yield after 15 years, because in a market with a very volatility interest rate hovering around from 4% to 30%, you can't have unit interest in this market. If the interest rate is a very stable settled interest rate, then of course then we can think of bringing unit link again. Otherwise it's not a concept here. But having said that, universal product or bonus products, partnership products are the predominantly the steady product is in this market at the moment. But it is unfair from the insurance company's perspective. Customers are expecting similar return if they put it in a bank account versus an insurance account. Completely different concept, because you have to understand about the protection aspect. But going forward, I would say, to answer your question, companies will more focus on protection element than investment, because this IFRS 17 accounting standard has already been implemented, then we have to comply. So there you recognize only the protection premium as your revenue. So you don't have a choice rather pushing more and more protection business in this market. Otherwise, we can't, as companies, we can't survive. And from the customer's perspective also, when we pay more living benefits, more claims, the experience will become a motivation for them to buy insurance and take this passage across, because you will feel the value of insurance, rather putting money and expecting something out of 10 years. That's of the game here. Insurance is a very, very novel concept. We are taking your stress, we are giving you peace of mind, and the real insurance is all about protection, business, and we don't have a choice. Eventually, we will all fall in that path, and protection element will definitely increase in next 5 to 10 years time frame. Thank you.
Yeah. So I think the question was about product mix. Uh, and so I didn't talk from a supply like perspective, but that's basically what I know. We have essentially focused on production. Our focus is on margin. So we want to make as much as possible. Whilst the top line is important, the bottom line is also even more important. And so we diversified distribution. And you take, for example, our agency distribution. When we sell, let's say 10,000 rupees, at least 50% of that goes to a protection kind of rider. It's a health critical illness, one of those covers. So, and that you're not getting your money back, but you're covered if that event happens, and if there is a health situation, you basically have a claim, and they will pay that claim. So, whilst uh, there is definitely the concept that customers want to have some return back on their funds. It's also equally important if we are in the protection business, if we are in the insurance business. Insurance, by its very word, is protection, right? I mean, that's what you keep corporate insurance company for. So we have focused almost our strong emphasis in terms of actually providing protection in terms of our policies. So like I said, when our agents said at least 50% is on health, critical illness, that type of thing. If you take our other channels, we have also a very strong concentration on health. We are the market leaders in the health insurance space. We have about 35% market share there. And just to, I think, mention a couple of other things that Laster picked up on earlier. So it is not a easy thing to do, right? But at some point, you need to also take perhaps a bold stand, a bold decision, and move forward with it. If you look back in this market to maybe 7 years ago, so Lasit also was with us, same team at that time. And when we looked at the health insurance space, yes, the reinsurance companies were covering health. And what we realized as a company was, when we look at that whole space, everybody is getting the same product, right? Everybody is getting the same product because the reinsurer is giving the same product to everybody. But what that does is that we are all tied at the hip. None of us can actually move out for venture out of that space. So at that point, then we took the decision, okay, we're going to drop the reinsurers, we're going to go net, and we are going to push forward into that space. And we've done that very aggressively, right? And I think financial services and health insurance is a scale business. If you have the scale, you can price. You can't start today and get into a risk product and try to price, right? Because we have the scale, we can price, because we are the market leader in this space, right? So I think the main thing is, once you get to that point, you can change your premiums, you can any kind of excessive claiming, you can cover those things, you can give good standards in terms of the claims payment space, all that kind of thing. But you need to get to that scale. Without getting to that scale, it is you have to then be careful. So I think just getting back to what the question was, insurance is about protection. We have health, which is a big component of the protection space, and I think what we need to now look at is the whole retirement and that protection gap, and how we address that through either annuities or whatever decumulation kind of products. As I think you already know, we just launched from SoftLogic Life what we call Health for Life, right? So This rider that we have put out is you buy the policy at, I don't know, 35, 40 years. You have that for the rest of your life. Right? It doesn't stop at 70 or 80. Right? We are being brave about this. We think we can price it. We have 15 years plus health insurance data. We are confident about that data. We know what we can offer, what we can price. Health insurance are also annually renewable, right? If the whole portfolio changes, the price changes every year. So I think we are being, I think we also want to look at society and what we give back to our community. So we have taken that step, health for life. It doesn't stop at 70 or 80. For as long as you live, we will basically give you a health cover. So I think that's a big step that we've taken as far as protection and the product mix.
Thank you, Mr. Itika. So, these answers like element of IFRS 17 implementation and EU framework being discussed. So, I want to have some more color on that. So, how the new framework will change the profits being recognized and liabilities being valued, and overall how the performance will be changed when the reporting framework changes.
Right, I'm not the expert on this that I don't know where the area of but anyway, so IFRS 17 is primarily aimed at the insurance industry, right? It is about trying to make the insurance business transparent, where the performance of an insurance company can be stated very clearly. So IFRS 17, I think in layman's terms, is about what they call a CSM, right? Basically, the margin of that you have on insurance. It is similar to if you take a banking book, it's like a net interest margin, for example, you just broadly compare. So if you have more protection-based product or more high margin products, your CSM will be higher. If you have more investment-based products, I think your CSM will tend to be lower. I think from a broad perspective, that's I think how it will play out. Having said that, I think for the first time when you translate into IFRS 17, you can make certain choices in terms of how you want to record your business. Once you make those choices, you can't change them along the way, or you can't change them very frequently. So how companies will pick those choices is going to be crucial, because I think everybody will also want to see what was my performance in the past. As soon as I adapt this, there can't be a big deviation from what it used to be previously and what it is going to be for the future. So I think IFRS 17 is a good thing. It is supposed to bring the transparency and bring out the margins and the value of insurance companies. Hopefully, the insurance companies on the back of this transparency will also be able to attract capital, which I think we need. And if you look at these protection gaps, and if we then look and say that IFRS 17 is going to drive the insurance sector also towards more protection margin-based products, right? Which is likely to happen. Then it's it's a win-win. So let's wait and see.
Stick your fingers. Oh, it is.
Yeah, I think yes. I think at the moment now, how we generate surplus is from a life business kind of a black box. Even only actuaries can understand. So, but going forward with IFRS 17 as it will be really transparent from investor's perspective, customer perspective, insurance company's perspective. You can compare each and every insurance company, everything you can compare. I personally believe it is really good. So then even customers can really understand what insurance companies are doing with their money and all those things. And more and more protection, as I said earlier, more and more protection business actually is the way forward for us. There's no other way, because only we recognize, as I said, the protection element of the business. Say if you sell 100,000 policy, if your protection premium is 30,000, you recognize only 30,000 as your revenue. Balance 7,000 you won't recognize as your revenue. So then this is how we current at the moment we have a data flippy based market share competition in the industry. Going forward, we never know a company will have different strategies each and every company will define their way of, reach the market. Maybe GWP based, maybe CSM based, maybe asset based. We never know. We are waiting how we are going to, compete to each other. But having said that, more than the competition, how you generate a better margin. End of the day, it's a business. It has to be win-win. From customer should win, and also company should win. And at the end of the day, we have to generate profit. So from both perspective, I think I really like this IFRS accounting standard. I think from even overseas investors' perspective, I think it will add a lot of transparency, and then they know what they are doing, what they are investing in. So we can attract more and more foreign investment also into the industry, which will eventually help us to double, triple the size of the industry, and most of the multinational players will come with IFRS implementation. And so therefore, I think we are very, very positive about that. And we're supposed to go live from 26 January. We never know. There are various concerns, but within next couple of years, we will go live, and then it will be completely different game going forward.
Thank you. Kilasit. Over.
Yes, so as Lasita mentioned, now for actuaries and it's best answered by actuary, but in the simplest of if I take a very simplified explanation, today SLFRS 4, you look at a company's top line, GWP, as the total premiums collected. It has no correlation to how much value they're plotting. So it's just a collection of all premiums. And if you look at how insurance company shows profitability, it looks at your assets and looks at how much excess cash you have over your reserve liabilities and declares it as profit in the simplest of forms. It's not as simple as I make it sound, but that is a simplified approach. Now, a company that keeps growing may not necessarily be able to show profitability because you have something called a new business stream. So a company that goes at 20-25% may have flat bottom line. And so this creates problems for analysts to review a company, for customers to view the stability of a company, and investors to view the stability of a company. This is where IFRS 17 really transforms the game. So the whole JWP concept will be replaced by something called a insurance services revenue. Like insurance services revenue is still driven by the premiums you write. But however, it factors not just the premium you write, but the value you create to your premium. That's where the margins become important. So it is how much margin you create out of the premiums you write. And whatever you write, the future profitability of each policy you write goes into a vault called the CSM. Now, this is a game changer because as an investor, you are able to look at the size of each insurance company's vault. What is the future profit release capability it has with it right now, right? And from this vault, you write back into your P&L as and when you service that policy, including the first year. Right, so this gives a very transparent view of how an insurance organization is reviewed, performance is reviewed, and it becomes easily comparable within the industry, and also it becomes comparable even out with regional players. Now, as we discussed in the forum, this alone will be able to attract a lot of foreign investments into the life insurance industries because your BNLs are now more transparent and comparable with regional peers. Even as a customer is able to really review the financial stability of a life insurance company. Because unlike many financial services sectors or non-financial services sectors, we do not sell anything tangible or immediate. As life insurance companies, we sell you a promise. We sell you a promise that may be delivered in 30 years. That is where financial stability of an organization becomes pivotal. And IFRS 17 will really give a very transparent, accurate view of an organization's health. Your CSM, that is your vault, how fast is your vault growing, and how much of that vault are you writing back into your P&L. Now, you can have a big vault, but if your expense ratios, if your policy lapses are taking a nosedive, you will not be able to write all of them back into your P&L. So that sort of visibility and transparency help build confidence in the life insurance industries in the industry for investors, the government obviously, and as well as life insurance customers in the long run.
Thank you, Saina. And this will be my last question on the moderator session. So, as the industry evolves, do you see consolidation gaining momentum in Sri Lanka? And beyond domestic market, do you think expansion into the regional markets is the next growth avenue for the Sri Lankan life insurers?
Well, I will leave it to some of the panel members to answer that. But in terms of urine assurance, we as an organization take a view that this industry is still a heavily underpenetrated industry, right? There is a lot more upside for this industry that is not really harnessed. And that harnessing that potential is a craft. However, with again the change in the IFRS 17 standard, the solvency standards will also change in the long run. With that, we may see situations where consolidation may happen, and that is, limited to that of each organization's strategic focus, even expansions outside of the country. But I think whilst expansions overseas will happen, I think what is more probable is investments into this country, into this industry, to harness the value and potential in the industry, because this is a heavily underpenetrated industry compared to every regional benchmark. Thank you.
Yeah, actually, yes. That's the point, because I know we are having different strategies as organization, but within the country, we have a huge potential, 0.62, maybe 3%, but 6 times the growth. So therefore, we have ample opportunities to expand within the country, for sure. We had about bit strategies, and we are doing that. You heard that, but the roadmap and everything. That's one side. On the other hand, company specific, other strategies, overseas expansions, even as HMB Life, we have plans, of course, various plans to getting into other territories, especially how to capture your diaspora, Sri Lankans who are living abroad, with the aim of coming back, retire here. There are a lot of people who are living outside, but the ultimate objective is to come back to Sri Lanka and retire. So we are targeting those markets and looking into with the bank, of course, HMB. We are trying our best to expand, because we have recorded 30% CAGR during the last 5 years, and this year itself more than 50% growth. So we are growing, and yes, and also if I talk about the consolidation, also I reckon life side I don't see much. Because we have 14 companies, all are doing well, and maybe pretty small players, but still I don't see the near future. But GI side, maybe there are 50 GI companies, and GI business is very hard. Probably there could be a few consolidations. I think we have already heard one. I think the best question is we can talk about those expansion, and I've already done big things, and I mean out you. So that from a HMB right perspective, I think we are of course we are growing, and we are expanding big time.
Thank you.
Yeah, so thanks. So I think when you look at this whole spectrum, and if you take the Softlogic life story, we've grown tremendously. We've grown 10 times in 10 years, from 2040. That's still there. 3.5 billion top line. In 10 years, we got it to 35 billion. Last year, we crossed 40. And now we are at the top of the market. I think just 19.3, 19.6% is the kind of market share difference. So I think you have to ask yourselves the question, what do you do after that, right? Because yes, we also believe that Sri Lanka has ample scope. It is underpenetrated market. The numbers basically tell you that. So there is not going to be any lesser emphasis in terms of focusing on the Sri Lankan market from Softlogic Life perspective. But I think what's important is to look at what's out there, and what more can you do, and what value can you bring for your stakeholders. And in that sense, if we have the talent, if we have the capacity, and if we have the propensity to step out of the shores of Sri Lanka and to capture an opportunity in another market, by all means, we should look at it. So, as I think we've announced our entry to Bangladesh. We've essentially bought a license, a small company, because the growth of that business is basically our opportunity and our challenge. Just give you a simple example. The market leader there, I think, the market leader there is Medlife. They have got 25% market share. Their top line in air terms last year was 80 billion air. Right. This year, probably Seneca and SoftLogic Life will cross 50 billion. Right. So the penetration there is about half of what it is here, is 0.3%. So the propensity and the opportunity to actually improve scale, and insurance is a financial services business, it's a scale business, right? So the opportunity in markets where there are bigger populations, right, is tremendous. But I think the main thing is that you have to know what you have with you. You cannot overextend yourself. You need to play within your expertise. So for example, if you take the Bangladesh market, health insurance is non-existent, right? So we are looking at that like the person who went there to sell slippers and says the one is wearing slippers, right? So from that perspective, we think there is a great opportunity to go into a market like that. And I think if you take also the perspective of Sri Lanka and Sri Lanka's exports, right? If you look at the crisis and the problems that we have had, what are those problems? Those problems essentially stem from the fact that we don't have exports. We don't have enough foreign currency coming back to the country. So if we are able to enable that, right, in a different form, right, in terms of exporting our talent, in terms of making investments outside Sri Lanka, and being able to grow assets that belong to Sri Lankan companies, and then finally making profits and repatriating them to Sri Lanka, that's one of also the key value drivers that we can actually achieve, and that we can give back, or that we can achieve for the national interest. So if you look at that, maybe there is scope to do one more or two more, but I think the important thing is to do the first one, do it well, and then use that as a case study for perhaps a kind of regional play. So it is all about scale. Sri Lanka has 22 million people, right? So Bangladesh has 180 million people. So similar to that, if you have the talent, if you have the capacity and the capability, by all means, we should look at how we can scale our businesses and basically make value for our stakeholders.
Thank you, Istika, for your thoughts. So that brings us to the end of our moderated session. So I open the floor for question. Audience may raise their hands and ask questions.
Thank you. My question, I spoke quite a bit about the under-penetration problem with the insurance industry in Sri Lanka. And you also alluded that India, which is a much larger population, the penetration is much higher. So just trying to get an understanding, okay, so how did it work in India and how did they take insurance to the grassroots level? When we look at Sri Lanka, the average contrast values are increasing with insurance fees. So obviously there is a demand for insurance in certain segments of the population, probably higher earners, but how do you take it to the grassroots? Is it a question of scale? Is it a question of accessibility? And what can be done from India to kind of increase that penetration?
Okay, I think number one thing is the drive from the government. You must have heard the history of India. Even the Prime Minister himself, he has introduced various schemes, say Pradhan Mantri Yojana, also those things. So government is really pushing insurance in India. In our country, sadly, none of the government, including Canada, no focus at all about this industry. They are trying to tax us, but they are not helping us. They're taking all the benefits away. that they are not support. That's why with this roadmap, we are trying to push the government, support us. Then we can take a certain burden from the government, especially health and retirements and all that things. Therefore, I think the main point actually, the vision, long-term vision of a government, no matter what is the party, if you have a vision for a country, and think that's the way to go. And if we can do that, otherwise it does your own can't do that. Luckily now the current regulator is really supporting, very proactive. That's the positive. Apart from that is our effort actually, our innovation. That's the only thing, nothing else in Smart.
No, I think Lasit said it basically. So I think at the end of the day, the state has to play a role because that's how, as I think I mentioned previously, there are certain blocks, right? And we need to find a way to cover those blocks of society that are not inclined to take insurance. So there has to be some central push to get that. So hopefully, I think we have, from industry perspective, we have a really good dialogue with the regulator driven by the Insurance Association. So hopefully we'll be able to come up with some measures that address all those elements, which is why the plan is stated up front by saying that we want to double penetration by 2030 and then a further tripling of that by 2035.
If audience have any more questions, they can raise their hands. In the interest of time, I ask the
So just one follow-up question. So on, I know that's the last decade or so, insurance industry has done very well in terms of growing the DWP space as well as being very profitable as well. Just trying to understand competition from outside the country. Do you look at any of the other foreign large insurers looking at our market or this region? Do you see that competition could come from outside, given that this has been a very profitable industry, and as you said, it's an industry where penetration is quite low, so there is a large growth opportunity that I'm looking at it of that sort, or is that something that what is it?
So I think that way, Sri Lanka is a bit unfortunate because you just look at India and what's happening there, right? And the investment that is basically pouring into India, right? So there is so much going on there that economy is growing at 8-9%, right? We are trying to grow at 3 and 4%, right? So, if there is such a big opportunity there and much more attracting, people will go there, right? They will. It's very unlikely that they will look at Sri Lanka. So I think that regional picture is, I think that's what it is, and we know that from different transactions, different initiatives that we've looked at in the past maybe 3 to 3 years. India is hot, so I think whatever strategies that we do, as much as possible, if we can piggyback on that economy, is what we should try to do. But to look at a Sri Lankan investment, the other thing then is for the government here and all the strategy, the national strategy is to make this attractive. We are going to grow at 10%. These are the things that we are going to do. This is how we are going to bring investment. If you bring this, you get this advantage or that priority. There has to be some kind of excitement like that, because otherwise it's simply in terms of volume and attractiveness. People from India even don't want to invest in Sri Lanka because there's so much happening in the domestic market, right? They like to keep that investment there. So those are, I think, outcomes.
Just to add on to that, see, we already had 2 international players in the market, right? MHCs already operating in life issues. Now, just because we have low penetration and upside potential, the low does not attract international players. The same fundamentals that apply to every other industry to attract international players applies to the insurance sectors. You need basic macroeconomic stability. Now, just because you're underpenetrated does not necessarily mean that growth is guaranteed. Growth depends on affordability, adoption, and government support, as it happens in every other market. Now, the industry is not expecting
dole out on the government. But what the industry is expecting is a framework that supports growth, which in return has a much better ROI to the government. Right? Today, the insurance industry has invested almost $1.5 billion in government securities. It's the single largest source of mobilizing household savings into public sector spend. Right? Now, just imagine if this industry is to grow to its true potential, what that means access to funding. Just on that test, imagine what this industry can be if the government is willing to it reduces public healthcare spend and pension spend and target that to the insurance industry by creating this play. Now, all of those solid platforms are necessary for an international player to look at this market as an attractive opportunity, not just the low penetration.
So not to sound too negative, I think Sri Lanka and the life insurance industry will do well. We will grow. We will make, I think, good profits. But I think the story and the situation is always much more attractive if there's a game plan for Sri Lanka as a country in terms of a national, economic drive. If we lift that, obviously that knock-on effect or that high effect will be an added bonus and an added incentive for Sri Lanka's life insurance industry.
Yeah, the other thing is three multinationals have been, HSBC, Standard Chartered, but they have stopped their retail business, and Alios Life, they sold their stake to software. And likewise, it's actually serious at the moment. So we are to attract, as Senat said, it's not just the opportunity. Government support is highly required to attack for it. Otherwise, they will never come. IFRS may be one good thing. I think transparency may add a lot of value to attract foreign investment. I see that as an opportunity.
We have one more last question.
That's good. Yes, that's it. Yeah, Lasita, use it for industry to double and triple in the next 10 years. You are asking for tax concession from the government. Now, there was a time that life insurance premium could be deducted from income tax as a qualifying payment. Yes, and now that is no more. No, what sort of incentives you are looking at, Lasita, if I may ask?
Basically, one thing that, of course, similar thing what we used to have, because then when you're filing in taxes, you get deduct the insurance premium. That's one thing, and also the government is trying to tax maturity and all other things. I have heard those things at investment products and all. Like, if you want to do that, they're going to kill the industry, because we are one side we are trying to put a roadmap with the government support. If they come up with various things, and I heard that even minister itself talked about taxing short term, investment insurance and all will really kill the industry, and we need more and more incentives rather bringing tax. They can tax us once we reach to a level. At this moment, the government should support us to grow and come to a kind of a regional level, and then of course you can bring all other controls. So I would say minimum at least what we enjoyed some time back, and we deserve that